Hey everyone, meet Kevin here. Today we're going to go through the release of the Federal Reserve minutes. I'm also getting this a little studio problem fixed, but it won't interfere with us going through these notes. So here we go. Remember, we want color and detail into what's going on with the Federal Reserve and potentially lags. Okay, here we go. They're starting to come in. So most officials backed a slowing pace of rate hikes soon. Various Fed officials saw rates peaking at a higher level than what they had previously announced. Remember, previously they projected 4.6%, and now it looks like almost all of them are in unison that they're looking at potentially higher rates. They're also talking about market resilience in light of what happened with the United Kingdom, which is actually quite interesting that they would talk about that because it kind of suggests that the market is resilient to also potentially more hikes, which is not exactly what we want to hear, right? But it's true. The market is pretty dang resilient right now. Here we go. Boom. Okay, fixed it. So we're going to go through these together. Got them up here. Most interesting nugget from the meeting so far, we've got various officials saw rates peaking. Okay, that's fine. We're going to go through the notes together. We'll do a summary towards the end as usual. Let's see what we've got here. So first I want to see, I'm going to just do a find for lag. Okay, 5 search results for lag. Here's the first one. Several participants observed that because of the difficulties in isolating the effects of monetary policy, changes in economic structure, or increasing transparency over time regarding monetary policy decisions, the historical record did not provide definitive evidence on the length of lags. This is something that Jerome Powell has been lamenting. He's been talking about, hey, it used to be that we would have 18-month lags. Now it seems like we're sitting at maybe only or having fewer lags. So a lot of uncertainty in those lags. It's actually 4 results, not 5. It would take time for the participants noted that with regard to both real economic activity and inflation, it would take time for the full effects of monetary restraint to be realized. And these lags complicated an assessment of the effects of monetary policy. Remember, in the statement last time, they added this section here, cumulative tightening of monetary policy. The lags with which monetary policy affects economic activity and inflation all need to be considered. Things that could lag are joblessness and unemployment, for example, companies starting to reduce investment spending, renewing contracts at potentially lower terms. Bloomberg right now reporting, to contrast a bit, the minutes showed that most backed slowing the pace of hikes. It's safe to assume that most means more than very. Yeah, okay, well. Let's see. Trying to see if we're seeing anything wild here. Right now, it looks like Treasury is flattening a little bit. Okay, that's fine. Let's get some more on lags. Members agreed that in determining the pace of future increases in the target range, we would take into account, here's that same phrase, the cumulative tightening of monetary policy. This is almost an exact copy and paste of what I just read. In fact, I'm pretty sure it is because that's what they added. The lags, there's that copy and paste again of the statement. Okay, fine. Let's see if we have the word recession mentioned in here. Where the word recession is actually mentioned once. The staff therefore continue to judge that the risks to baseline projections for real activity were skewed to the downside and viewed that the possibility that the economy would enter a recession sometime over the next year as almost likely as the baseline. Oh, wow. That's actually a big change right here. Really, really big change. This is the first time I've actually seen the Fed, who's always been talking about, oh, we're not going into a recession. We don't have a recession in our forecast. Look at this. This is the first time the Fed has said, we view the odds of going into a recession at just as likely as our baseline projection. That's really big. That's a huge change right there. Wow. That's actually bullish for the stock market because the Fed's finally realizing they're causing a recession. Although I suspect that was their intention from the get-go. They just didn't want to politically say it. That's a huge change right there. Okay, so only one mention of recession. We have never seen that all year from the Fed. It's always been, I don't know. But Jerome Powell did say it's getting less likely we're going to have a soft landing. Big shift right there. Okay, so let's see inflation commentary. 9 matches for inflation. Well, 9 pages. Okay, so probably every page. Data received over the period, higher than expected core inflation. That's fine. Remember, this FOMC report actually came before the last soft inflation read. So I don't really care so much about that right now. Let's see here. In response, fiscal authorities in Europe and Japan, that's fine. Okay. Remember, the Fed does not want to see equity prices rebounding up. And so that's what they talk about here a little bit, seeing equity prices rebound up, at least not until inflation goes down, right? And that's really important. Synchronous declines in inflation problems. Okay, inflation remaining stubbornly high. Viewed the risk to inflation projection as skewed to the upside for real activity, sluggish growth in private domestic spending, and a deteriorating global outlook. Tighter financial conditions are all salient downside risks to the projection for real activity. The possible persistent reduction in inflation could require greater than assumed tightening. It could, but remember that lower CPI report came out after this report right here. We got some commentary on Ukraine, supply and demand imbalances, the war, that's fine. With inflation remaining far too high, showing few signs of moderating. Again, that changed after CPI and PC or PPIs. Participants agreed that inflation was unacceptably high. Yes, that's true. But what is not unacceptably high are the amazing prices on the programs on building your wealth. 60% off coupon code expiring this Friday. It's Black Friday, folks. Biggest sale of the year, biggest coupon code we've ever had. Remember, I will be ringing the bell to the New York Stock Exchange on December 9th. If you're a course member, you could fill out a form, and 125 of you are going to get a raffled opportunity to come totally for free to the floor of the stock exchange. It's going to be super cool. Participants agreed that near-term inflation pressures were high, but some noted that lower commodity prices or the expected reduced pressure on goods prices due to an easing of supply constraints should contribute to lower inflation in the medium term. Maybe. One of the things to remember is that companies don't necessarily have to lower their prices, right? When we look at what Dell is saying, they're not actually talking about lowering their prices. They're talking about increasing their margins, taking more profit, worth noting. Okay, let's see. Participants remarked overall measures of medium longer term inflation expectations from surveys appeared to have remained well anchored. Ish. Yeah. A couple participants observed that longer term inflation expectations were stable even as measures of near-term inflation expectations responded to realized inflation in line with historical patterns. You're right. So what they're basically saying is here, when you see inflation reports come in hot, then inflation expectations can actually go up. Like there's a little bit of a skew there. Okay. Okay. Full effects monetary policy restraint, that's fine. Okay, let's get a little bit more here. I'm just also peeking at Bloomberg. Bloomberg's still just picking up the story about the cumulative lags. That's not the big deal, folks. If you're just now joining, the big deal right here is this. The staff therefore continue to judge that the risks to the baseline projection for real activity were skewed to the downside and viewed the possibility the economy would enter a recession sometime over the next year as almost as likely as the baseline. Okay, so it's basically saying recession just as likely as not. Yeah, there we go. Here we go. Okay, let's keep going. Okay, so let's see here. Oh, there was nothing there. Okay, here we go. Russia's war against Ukraine, tremendous human and economic hardship, maximum employment, still a maximum employment, stable prices. Those are the two goals. That's the mandate. That's fine. We know that. Anything about mortgage-backed securities? Reinvest into mortgage-backed securities, the amount of principal payments, the Fed's holding, that exceeds the cap of 35. That's fine. MBS, let me see here. Any talk about selling MBS, mortgage-backed securities? Spread of MBS on treasuries widened, reflecting the sensitivity of these spreads to increased volatility. That's fine. Because those spreads have tightened. This basically has to do with mortgage rates, and those mortgage rate spreads have tightened a little bit already. They were spreading earlier, but that's already old news, so that's not a big deal. No commentary here on them potentially dumping mortgage-backed securities. Okay, so let's see here. Let's see. Is the word pause here? How about slow? Okay, here we go. Slow. Nonetheless, contacts were increasingly focused. This is context. So this is the survey people, not the Fed, focused on the question of whether the committee might slow. People, my pencil stopped working. Come on. All right, I'll just go no pencil. Then I'll go. That's it. We'll use the finger. Oh, okay. Nothing's working right now. Fine, whatever. That works. There we go. Okay, working again. All right, that was annoying. Slow, but this, again, it doesn't matter so much what the comments are. We want the staff's comments, like not the other surveyed people. We know people want to know if the Fed's going to slow down. Okay, slower than the pace we had seen in recent months for unemployment. That's an interesting comment. Nominal wage growth continued to be rapid. Average hourly earnings rose 5% over the 12 months ending in September. However, the 3-month changes in ECI, Employment Cost Index, were notably lower than the average pace seen over the first half of the year. That's bullish. So what I'm going to do is I'm just going to start putting like positive or negatives, right? That's definitely a positive. In response to high inflation, central banks further tightened around the world. That's fine. The rise in borrowing costs appear to have slowed the volume of financing in many credit markets, not in credit cards. Oh my gosh. And if we did this in the course member live stream this morning, we looked at trends for a firm. The areas that are really blowing up for a firm are, I mean, somewhat unsurprisingly, the poorer areas. If you go look at the south of the United States, Tennessee, Alabama, the Carolinas, they're the ones that are actually seeing a higher share of people searching for a firm and signing up for a firm potentially, which is very interesting because that aligns with lower median incomes. Credit quality remains sound overall. That's true. We've seen that pretty consistently. No craziness on defaults or foreclosures expected. Issuance of corporate bonds, although quite strong in early September, slowed significantly in late September, October. It's getting harder to raise institutional money. We have noticed this as well with, with house hack. It's very difficult to raise money near the bottom of the market, right? Things got really bad in September and October. We're still able to raise over $22 million. No, I'm sorry, over $27 million now, which is great. So we're in a pretty great position, but and we expect that to blow up even more so, especially when we launch our Reg A. But we would love the market to go up. We would love there to be a sustained rally in the stock market so people can diversify into real estate. househack.com, read the PPM. This isn't a solicitation, right? But anyway, the problem is it's very difficult to raise money in a tight environment like this. And so again, we're very grateful that we are even able to. Anybody can raise money, like good old Sam Bankman-Fried. He can raise money in the boom times, 2019, 2020, 21. And that guy still upsets me. Everybody got duped. Even Sequoia was talking about how they reviewed their financial statements for FTX and they believed them. We didn't even have access to that kind of stuff. It's crazy. So let's see here. Contributing to slowing. Participants comment, labor market having remained strong to date, even alongside the slowing of economic activity. I was just also going through Best Buy in their earnings call, and it's very interesting how they talk about being more competitive and price competitive, how they're noticing a slowing, obviously, in the economy as well. I mean, everybody's noticing a slowing in moderation. I mean, this is just not a surprise. This is what I do, okay? I sit here and I read PDFs all day long. Several participants remarked that rent increases on new leases had been slowing. Good. Yes, this is what we want. We want the Fed to be aware of this. But participants also noted it would take some time for that development to show up in that PCE. That's bullish right here. That's bullish. This is the Fed saying, hey, look, we know it's going to take time. We know it's going to take time, folks. We're trying to give you the heads up. That's bullish. I like that. That's bullish. You know, this is I would say this is sort of moderate, where they talk about like, hey, we don't know the effect or of what kind of lags we have. Global headwinds, including the slowdown in China, Russia, Ukraine. Fine. Remember, we're kind of bouncing around here looking for the most important parts. Let's see. Leaning towards a 50 basis point hike in December following 4 straight 75 basis point hikes, as a substantial majority of officials judge that the slowing paces of increases would soon be appropriate. Let me see this. Substantial majority. Here we go. All right. Yep, here it is. A number of participants observed that a monetary policy approach stance was sufficiently restrictive to achieve the committee's goals. It would become appropriate to slow the pace of increases in the target range for the federal funds rate. In addition, a substantial majority of participants judged that a slowing in the pace of increases would soon be appropriate. A slower pace in these circumstances would better allow the committee to assess progress towards its goals of maximum employment and price stability. The uncertain lags and magnitudes associated with the effects of monetary policy action on the economy and inflation were among the reasons cited as to why such an assessment was important. Well, okay, yeah, so basically, look, we probably need to slow down because we don't know. So in English, we probably need to slow down because we don't know what could happen. Interesting. Okay, next. So several officials voiced concern that a continued rapid pace of tightening would risk financial instability. That's probably why they were debating the United Kingdom, because the United Kingdom had, I mean, the Fed had to bail out markets. One thing to keep in mind. Okay, could reduce the risk of instability in the fund. Slowing pace of increase could reduce the risk of instability in the financial system. Okay, let's get the full context of that. Oh, it's right here. A few participants commented that the slowing pace of increases could reduce the risk of instability in the financial system. A few participants noted that before slowing the pace of policy rate increases, it could be advantageous to wait until the stance of policy was more clearly in restrictive territory and there were more concrete signs that inflation pressures were receding significantly. Well, we kind of got that in the last report. So honestly, I mean, to me, these minutes are screaming 50 basis points. This should be pretty obvious right now. Let's see here. Let's get a projection, and then I'm also going to get the Fed term. All right, here we go. Okay, so earlier we were at a 5.24 terminal rate for the Fed. It's fallen. That's a bullish sign. Okay, so after minutes, terminal rate projections down from 5.24 to 5.15. Okay, let's make that little note here. And projections for what rates could go to should be down. I don't know if that's updated yet, because that doesn't make sense. Oh, wait a second here. 25 to 50 basis. FOMC. I'm trying to understand these projections here really quick because they're just updating as they're happening right now. Okay. Well, remember, we're right now at a range of 3.75 to 4. And I'll show you this. 3.75 to 4 is where we sit right now. And these are the current projections here. That's a 50 basis point hike, 71% probability. I'm a little surprised that the current versus previous probability actually went down from yesterday. I don't think this is updated yet, because this number should be going up after these minutes. So a 71% chance of a 50 BP. That's so I expect that'll change. I'll give that an hour or so and I'll come back to it, because it doesn't make sense. Okay. UK bond market, treasuries remained orderly during that disaster, would not affect the stance of monetary policy. Okay, orderly. Let's look at this. Orderly. Here we go. Increased volatility appeared to contribute to a decline in measures of market liquidity in core fixed income markets, in particular around the period associated with UK volatility, but market functioned orderly. Okay, that's fine. Financial stability, treasuries functioned orderly, right? Because the UK's gilts did not. Okay. I'm surprised they still have not mentioned this on any of the sources that I'm looking at. Nobody's actually talking about the Fed, and that always makes me nervous when nobody else realizes it, because I'm like, am I reading it wrong then, is sometimes what I think, but I don't think I am. But so far, I've not seen anybody mention this paragraph. And I think this is the most important paragraph right here. This is a huge change. So this is page 6 of the FOMC notes. And it's right here, folks. It's this section. The staff therefore continued to judge that risks to the baseline projection for real activity were skewed to the downside, and viewed that the possibility the economy would enter a recession sometime over the next year as almost as likely as the baseline. In other words, they view it right now. I'm going to write this in English. In English, it's we think it's just as likely for us to have a recession as our baseline outcome as not. As our baseline outcome. So baseline outcome is no recession, but below trend. There, that adds some clarity. Below baseline, negative trend. There we go. So here's English. I think this should add a little bit more simplicity to that. In English, we think it's just as likely for us to have a recession, which would be below the baseline estimate and negative GDP. I should say negative GDP rather than trend, right? As our baseline, which would be positive GDP and no recession, but below trend growth. That should add a little bit of clarity. Okay. And how's the market actually seems relatively positive on this. We're certainly up more than we're down. So you can see that right here. The minutes just came out here. And you can see that initial volatility that almost looks like barcoding. And then you sneak up over here. Huh. Okay. Very interesting. So, okay, those are surveyed comments. And we're going to do a review here in just about a minute, because I think I've gone through most of this, but I want to make sure of that. So we're going to do a review in just one moment. Let's see here. More uncertainty. Okay, with regard, okay, many participants, timing of the effects. No. Current circumstances. Let's see if I can find this. Current circumstances. Here we go. Okay, this is another section that just got highlighted. With regard to current conditions, many participants remarked that even though the tightening of monetary policy had clearly influenced financial conditions and had no notable effects in some interest rate sensitive sectors, the timing of the effects on the overall economic activity, the labor market, and inflation was still quite uncertain, with the full extent of the effects yet to be realized. Several participants have observed that because of the difficulties in isolating the effects of monetary policy, changes in economic structure, or increasing transparency over time regarding monetary policy decisions, the historical record did not provide definitive evidence. Right. We had actually read that lower part earlier, but this little pre-part is actually somewhat useful as well. This is not hawkish, right? And I think that's important to know. It's not hawkish. It's not hawkish would be, we will stop at nothing to raise rates, right? That would be very, very hawkish. You're not getting that here. You're getting caution. You're getting caution that the risks are two-sided. So I find this actually pretty good. Risks two-sided. You know, too tight, too loose. All right, that's a two-sided risk. There we go. Okay. See anything else? Yeah, terminal rate projections against fell from 5.24 to a 5.15. Treasury yields fell. That's actually a really good sign. That's a good sign. So that means bonds are starting to rally a little bit again. This is a reiteration that I mean, we're about to be below 3.7 on the 10-year Treasury. This is actually really good. It's neutral, waiting on data. Says one of the chat members here. Yeah, I agree with you. I completely agree with you. So that's why it's a neutral. It's not a plus or a minus. But well, I mean, it's certainly not a minus because again, that would be hawking. Reverse repo facility suggested that over time conditions could evolve in a manner that would lead to falling usage of the reverse repo facility. Well, that would have that has not happened. However, the manager pro term noted that money market conditions could change somewhat more quickly in the lead up to the year end because of normal factors such as treasury tax payment date in December that could increase the treasury account balance, blah, 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 blah. This is a little bit about balance, isn't it? I don't think this is terribly market important right here at this point. H4 statistical release. These are interesting. That's where kind of where you get like the consumer credit data and such. A very complicated form to read, but it's quite fascinating. Okay, that was a reiteration of data. What have we not? In response to high inflation, many central banks continued to tighten monetary policy, albeit at a slower pace in some areas. Fine. Here's some COVID zero talk. The Chinese renminbi depreciated significantly against the dollar because of the COVID zero policy. Well, that's not being helped at all right now by what's going on over at Foxconn particularly. Participants agreed that inflation was unacceptably high. The burden of high inflation was falling on low-income households. Shelter is making up a large share of expenditures, especially for lower-income households, correct? Functioning in the treasury market was orderly. All right, we're going to do a summary in about a minute here. Oh, here we go. A few participants commented that ongoing tightness in the labor market could lead to the emergence of a wage price spiral. That's even though one had not developed yet. So this is the same as what they wrote last time. They wrote this in the last minutes as well. And I'm going to mark that actually as neutral because there's no change. When they added it last time, it was actually bad because they had just added it. Now they left it. Let's see if they said anything else about spiral. No. Despite the slowdown in growth, the labor market remained relatively tight. Fine. Anchored expectations, good. Lags, good. Okay. Policy action, we already know. 3 1/3 to 4. ECI moving down. Okay, good. Yeah, this is great. Let's go ahead and do a summary. NASDAQ right now up 1.12%. I think this is, I just want to tell you this. I think these notes could actually lead to a rally between now and CPI week. I really think that. I put some money on that thesis. I talked about that thesis yesterday. I think between now and CPI week, you could have some real optimism, which I'm really excited about. So again, we're going to do a summary and yeah, let me hit record and do the summary. So, all right, here we go. Hey, so the Fed's minutes just came out from the November meeting, and there's a big shift in one particular thing that was just said by the Fed, and we got to break this down along with some of the other items. We'll break this all down in a quick summary here. I'm only going to mention it once in this video, so we're going to keep it to right here. Yes, Black Friday is in 2 days. Yeah, there's a 60% off coupon code. Yeah, I keep adding content. You get lifetime access. There are no monthly fees. You get live streams. If you join Elite Hustlers, which is to increase your income, you're going to get the live stream access to the Hustlers live streams and the exclusive content there and the course member live streams if you join before Black Friday. And all the other courses get the course member live streams as well, of course, for stock and real estate analysis. I will also be ringing the bell at the stock exchange on December 9th for market close. We'll do a public meetup outside at about 4:30. Depending on when things wrap up inside. And we'll be ringing the bell at 4 p.m. If you're a course member, you can submit a little thing in Discord, the little form, and you could come potentially for free. We'll be doing a raffle. Okay, let's talk about the Fed. The biggest shift from the Fed, and I'm surprised how few are picking up on this in the mainstream media, but it was the first thing that I noticed and tweeted about, and I'm like, this is a big deal. This is a big shift, is right here. This paragraph is critically important. With inflation remaining stubbornly high, the staff continue to view the risk to inflation projections as skewed to the upside. That's not new. That's old, okay? They've always said that the risk is inflation goes to the upside. Fine, that's the old part. For real activity, sluggish growth in private domestic spending, deteriorating global outlook, and tighter financial conditions were all seen as salient downside risks to the projection for real activity. Remember, the more real activity goes down, the less the Fed has to hike. And there is the possibility that persistent falling inflation could require a greater than assumed amount of tightening. Okay, so this is a backwards way of saying it is possible we have to raise rates more to get inflation down. Because of that risk, we are now saying, and folks, this is the first time the Fed has said this, they're now projecting that real activity risks on their baseline are equal to the potential chance that we enter into a recession sometime over the next year. We've also had the inversion of the 3-month 10-year, usually a really good indicator that a recession is about 9 months away. Now, I did translate that in English here. Basically, the Fed just told you, we think it's just as likely for us to have a recession, which means negative GDP and slower growth. And we think that is just as likely as our baseline forecast, which is no recession, positive GDP, but below trend growth. Remember, if trend is 3% GDP and we're growing at 2%, that's below trend. If we're growing at negative 1%, so shrinking, then we're in recession with 2 quarters in a row, right? Unless, of course, you're the White House. Then you don't believe you're in a recession when you have 2 quarters of negative GDP. But we don't want to get political. We want to focus on the commentary here from the Federal Reserve. Looking at some of the other notes, by the way, I encourage you to look at this page, very important, page 6 of the FOMC notes. You can get it at federalreserve.gov. So here, we notice the Federal Reserve is recognizing that one of the most important indicators in labor market conditions is showing that employment costs are beginning to fall. The ECI is known as the Employment Cost Index. It tracks hourly compensation and benefit costs, and it fell, or I should say, it grew at a slower pace. It was noticeably lower than the average pace seen over the first half of the year. This is very good and helps offset some of that risk of a wage price spiral. Now, the wage price spiral comment was added in the last minutes for the September meeting. And these notes have not changed. That wage price spiral argument is still here. They haven't made it worse. They haven't added to it. They haven't changed anything. They also 2 or 3 times mentioned this phrase that they added here in the FOMC statement that came out on November 2nd. And that was the statement that in determining the pace of future increases in the target for the federal funds rate, the committee will consider the cumulative tightening of monetary policy, the lags like unemployment and businesses slowing down and that, how long it takes for that to filter through the economy, and economic and financial developments. This is really important. And they mentioned a few times in this report that, especially with this paragraph here, and you could pause the screen here if you want to read this, but it's very important to realize the Fed does not have a historical record to tell us how long the lags are. And the Fed is being very cognizant of this. Not only are they being very cognizant of lags, but they're also saying, hey, look, we realize that prices for things like some commodities are coming down. We also realize that rents on new properties, on new leases are coming down. but we recognize that those show up with a lag. So commodities coming down, rents coming down, those take a while to show up in our favorite measure of inflation, which is PCE. That's their version of the consumer price index. This is actually the personal consumption expenditures report. So the Fed is being very aware that we have risks. And I think one of the things to know is Jerome Powell realizes he has the power to change his mind. Powell has the power to flip. And so what does that mean? Well, it's very simple. We can slow now, this is my opinion, to 50 basis points. If things get worse, we can always hike more. Say inflation gets out of hand, they could just rug pull us and go, that's it, we're raising rates 2%. They know they have that flexibility. But they also know, but we can also freeze hikes or reduce rates if we want, when we want. And a lot of this is going to be dependent on the December CPI report. And so if there's anything you do now, in addition, well, I'm not going to mention it again. I was going to mention it, but I didn't. I'm being a good boy. What you do want to write down and take advantage of right now is December 13th CPI report. The CPI report comes out 5:30 a.m. on December 13th. And then at 11 a.m. on December 15th, all these times, by the way, Pacific Standard Time, on December 15th at 11 a.m., we will have the FOMC rate meeting. This is where the market right now is widely expecting interest rates to go up by 50 basis points. That means we would see an increase from the present range of 3.75 to 4, up 50 basis points, 50 BPs, all the way to, just so you could see this visually, 4.25. There we go. To 4.5. I can't write well today. There we go. That's terrible. Anyway, right now the expectation is that we are going to see this 50 basis point hike with a 75.8% likelihood. We've also seen the Federal Reserve's terminal rate from this morning go from 5.24% as a market implied terminal rate down to about 5.15%. What else did the Fed tell us? Well, they told us that they saw that inflation expectations were relatively still anchored. We did see an increase in near-term inflation expectations, but that was likely due to CPI coming in higher. Do also keep in mind there are quite a few bullish things in this, or should I say dovish things in this. Like, hey, let's not go too hard. Let's realize that ECI is coming down, the employment cost indicator. Let's realize that things operate with a lag, like commodity prices coming down. The economy is starting to slow. We could always hike more in the future if we need to, but a lot of dovish things in this. But what's remarkable is even though we've got a lot of dovish things here, what do we have? This report actually was established. This meeting happened before the last CPI report, which is really, really incredible because the last CPI report we had a substantially below expectation release of the CPI report, and PPI thereafter about a week later came in also below expectations. So very, very good. I still pat myself on the back for nailing that CPI. I'm setting a high bar for the future though. That's going to be tough to nail that again. I was way outside the average economist estimates and still nailed both of the numbers. Damn. Oh, I should have played the lottery for that $1 billion lottery that week. A substantial majority of participants judged that slowing the pace of increases would soon be appropriate. And some of them are saying, look, we probably need to slow down because we don't know what could happen. We don't know how we could affect financial stability. Remember that the United Kingdom had a financial stability disaster in their gilt market, which actually ended up leading the Federal Reserve, the Central Bank of England, and Mr. Bailey, the governor of the Bank of England, U-turning and basically having to print money. They ended up only printing $20 billion to bail out the bond market. But they said they would bail out the bond market by an infinite amount. And that was enough to stabilize the market again, which was very, very interesting. You are seeing the 10-year Treasury yield bob around the lower end of about 3.7. I'm also curious how inflation expectations have moved. Remember, the 5-year break-even inflation rate is somewhat of a daily tool that we can use to analyze what inflation expectations are. And that rate has ticked down a little bit this morning. I'll go ahead, after these minutes came out, I'll go ahead and throw that on screen in a moment here. Well, I'd like to. There we go. All right, inflation break-evens on screen now. And, oops, I think I used the wrong one because that was this morning's. My bad. I did. There it is. There's the appropriate one. Well, it actually shows you the difference now that I showed you both. I have both of them on my desktop. This is a zoomed in of the right. You could see that this morning we were kind of ticking up a little bit, and now we're actually ticking down a little bit. This is a big deal. I know this sounds like stupid. It's like, come on, man. It's like one chart. This is important, okay? Now, I guess since I told myself and you that I would not say anything else, I'm just going to thank you for being here. Consider subscribing. I hope you found this useful. Oh, I should talk about the market really quick. Sucks for anybody who clicked out already. I think this is bullish. I think between now and CPI week, we're probably going to see a lot of institutions start moving money into the market. A lot of them are in a holding pattern. They're sitting. But I do think CPI week and Fed week is going to create a lot of anxiety. And so I wouldn't be surprised for you to see a sell down closer to the CPI period of time. Anyway, there you have it. Enjoy Thanksgiving tomorrow. Thank you so much for being here. I do appreciate you as a subscriber. And we'll see you in the next one. Goodbye. Good luck.